Good morning, everyone. We're going to talk about derivatives. More than half of all cryptocurrency volume globally trades not in the spot markets, like converting Bitcoin to USD, but actually in derivative products, like futures that expire to some future price based on an index, or options that allow you to settle some future underlying contract based on whether the underlying asset has gone above a strike price or not. Derivatives are important for a number of reasons. They give you opportunities for hedging risk, for providing capital efficiency, for a form of insurance, transferring risk between two parties, and being able to put on spread trades, for example, between the underlying asset and the actual future. So derivatives are an important and vital fixture of any healthy market, for example, equities and bonds in the US. So last year, FTX US acquired a company called 𝗦𝗔𝗟𝗧, which is a CFTC-regulated derivatives exchange and clearinghouse. 𝗦𝗔𝗟𝗧 has a few licenses that are key to us being able to offer these products to US customers. It has a designated contract market license, which is an exchange license offered by the CFTC. It also has a derivatives clearing organization license, which allows us to clear regulated derivatives trades. It is now a publicly known fact that FTX US intends to be the first ever crypto-native platform in the US to be able to offer futures on Bitcoin and Ether directly to US customers. And in fact, we have an application out there with the CFTC as we speak that's out for public comment to enable margin in our clearinghouse, so we can offer the first ever 24/7 real-time margining system directly to retail and institutional customers for crypto derivatives. But what's lost from the story here in the public narrative is the degree to which FTX US derivatives is going to forever disrupt the traditional financial market structure for derivatives. And this disruption cannot be overstated. But to talk about that fact, we have to go back a little bit and give the background of some traditional exchange market structure as we see it now. And to do that, I'm going to tell you a little bit about my background in the industry. Prior to coming to FTX US a year ago, I worked at several of the largest proprietary trading firms. These are firms where we built algorithmic trading systems and low-latency order gateways and market data handlers, and traded assets from a variety of different asset classes, securities, equities, ETFs, bonds, futures, commodities, on venues across the world. What's apparent to me now, having left that industry and coming to crypto, is just how enormous the barriers to entry were to being able to compete in those spaces, especially in the space of trading derivatives. Let's talk about the status quo right now on some traditional exchanges and CCPs, central clearing counterparties. For example, market data. In order to be able to actually see the full order book of an exchange, you have to pay tens of thousands of dollars per month. And that's just to get certain products. Some exchanges actually require you to pay additionally based on which kind of asset class of derivatives you're getting, whether it's crypto versus agricultural products, energies, bonds, equities. Order entry sessions, just to be able to connect to the exchange to send orders, will require thousands, sometimes tens of thousands of dollars per line to the exchange. And many of the most successful high-frequency trading firms, in order to be able to send the full amount of orders they need to send to the exchange, need to buy hundreds, sometimes thousands, of these order entry sessions. and to even get the best access to that exchange, so you can have the lowest latency connection to the exchange, you have to go directly to the physical building of the exchange where the matching engine is housed. You need to rent server rack space, buy lots of server boxes, and put them right next to the matching engine just to get that best access. That'll be an additional millions, sometimes tens of millions per year, just to get the appropriate space to get yourself the best access to the exchange. Another fact, for most traditional exchanges, you cannot connect directly to an exchange. You cannot open your phone, sign up for an account, and start trading. You have to go through an intermediary and pay fees to that intermediary to get onboarded and start being able to connect to the exchange, unless you go through the lengthy process of getting the appropriate license to be able to become a clearing member of that exchange yourself. And lastly, it is now publicly known that for many of these trading firms, in order to create the best pricing models to be able to trade on these exchanges, you might have to pay for microwave market data, a series of microwave towers that go from New Jersey, where US equities trade, to Illinois, where many derivatives trade, to pull those equity market prices over a series of microwave towers along the Great Circle from New Jersey to Illinois to get yourself the best pricing models close to the exchange. Now, for some of you, I can see your eyes are glazing over. Maybe you think this is boring, or it's insane, or some of you who are used to working in this space are exhausted by it, because it's what we have accepted to be the fact of markets. It's where the competition has brought us to. It's where the exchange market structure has brought us to. It is just now a fact of those markets that you have to have this enormously capitalized entity with all of this money to spend just to be able to compete at those high levels for trading derivatives. Now let's talk about FTX. On FTX US derivatives and the rest of the FTX platform, market data is free. Anyone can connect through public access over a WebSocket or through our mobile app or our web UI and get the full order book for any product for free. Yes, free. Order entry is also free. Anyone can connect to the exchange, and if you're onboarded through our process, you can send orders for free. We don't charge per line. We don't charge for rate limits. Of course, we charge per trade fees, as all exchanges do, but we don't charge for this particular access, which means anyone can receive market data and send orders to an exchange entirely at zero cost. To actually onboard onto the exchange, we can take customers directly onto the exchange. To sign up for an account, all you do is you go onto our website, you go onto our app, you go through our onboarding process, and that's it. For most people, it takes around 60 seconds to finish getting onboarded onto the exchange. Intermediaries are optional. There are many reasons why, especially large institutions, can benefit from having intermediaries that help manage capital efficiency across multiple exchanges. But for the average retail customer, they can just onboard directly onto the exchange. And lastly, FTX's actual technology is housed in the Amazon cloud. It's not in a physical data center in Aurora or Secaucus, New Jersey. It's in the Amazon cloud in Virginia for the US. What this means is that if you want to have another node yourself in the same cloud region as FTX, you can go directly to Amazon and purchase these cloud nodes yourself. They're extremely low cost. The same access is available to large institutions as to a person with a laptop in their garage looking to start algorithmic trading on FTX. Not to mention the resiliency of being able to move the exchange in a matter of hours from Virginia, let's say, to the Ohio data center for Amazon's cloud in the case of any sort of business continuity issues. And lastly, being in the cloud all but eliminates the advantage that one could have by being able to have access to low latency order connections and low latency market data. Again, for some of you, this sounds fairly boring, because this is exactly how all cryptocurrency exchanges work. Cryptocurrency exchanges, which were created, let's say, around 1 decade ago, they were created by people who were technologists who thought, if I'm going to create the exchanges from first principles, I want it to be as simple and easy as possible. I want it to match the spirit of crypto, which is to allow open access for all participants. I'm just going to make one program on one server where the only participants in any trade are the buyer, the seller, and the exchange in the middle. But for FTX, it takes a visionary like Sam Bankman-Fried, who has that knowledge from working at a place like Jane Street to see how that traditional market structure works, and can step outside of it and say, how do we actually rebuild this from first principles? How do we not anchor ourselves to the status quo and burden our users with needing to go through intermediaries if they don't need to, from paying large amounts of money just to be able to access the basic market data for the exchange, to be able to connect to the exchange? And how can we completely turn the existing market structures on their head? And not just for crypto, but also for traditional products like futures and options. So let's say we get our application approved to the CFTC, and we're now able to offer these products in the US. Besides for these technological differences and differences in costs, the most significant difference between FTX and traditional CCPs is the way that we handle margin. Margin on an exchange is when the exchange calculates the level of collateral you need to put in your account in order to be able to fund a position. You might think, if I have to buy $100 of Bitcoin, I need to put in $100 to get that $100 of Bitcoin. But on most futures exchanges, that's not the case. Sometimes if you want to put on a $100 position in a future, you only need to post $20 to be able to fund that position. And then as your position value starts to go down against you, the exchange might come back to you and call for you to put in more margin. And eventually, if you're unable to do that, they might have to close down your account, close down your positions, and liquidate you. It's this setting of margin levels, the ability to call margin, and the method of liquidation that creates the risk profile of any exchange. On traditional CCPs, margin is usually calculated once per day, 5 days a week, and not on weekends or holidays. What this means is that if on a Friday at 3 p.m. you put on a big futures position, and then world-shocking news happens on a Saturday that could very well move those markets a lot, the exchange will have to deal with 2, sometimes 3 days on long holiday weekends before being able to actually remove that risk from the system, before being able to properly call those margins back into the system, before being able to properly liquidate customers. The result is that after 2 or 3 days of volatility, Monday or Tuesday comes, and there's huge price dislocations. People can't post margin in time, they get liquidated. That moves the price of these assets. That cascades to more liquidations, further moving these assets. And suddenly risk is increasing at a rate that can't be controlled. The FTX system computes margin every 30 seconds, 7 days a week, 24 hours a day, 365 days a year. So we're, yes, margin, real-time margin. We compute margin in real time, which means we only have to worry about how much prices move within a 30-second interval, as opposed to a 48 or 72-hour period. It enables us to have much greater confidence in being able to remove risk from the system. Another difference is that for FTX, all the collateral in the accounts are required to be posted directly with the clearinghouse. This is different than the traditional model, where we're relying on intermediaries to be able to put that margin back in the clearinghouse when they're called. And they might be extending credit to their customers. And so you can't actually measure what is the full risk in the system. With FTX, you can measure the full risk based on the collateral posted at the clearinghouse in the margin model down to the cent at any given time. The differences between these two models are not just theoretical. There are real-world examples, recent real-world examples, where the differences between these two models show the inherent risk in the traditional system. On March 7th, on the London Metals Exchange, largely as a result of the conflict in Ukraine, the prices of LME nickel forward contract prices skyrocketed. There was one or possibly several accounts that were highly leveraged short against this market. Their accounts went so negative, and they were not able to be called to get that margin back in the clearinghouse, that the LME had to actually shut down. They took the unprecedented step of shutting down the entire market. The next day, when they tried to open back up again, they realized they had a multi-billion-dollar hole to fill, and they couldn't fill it. So what do? They canceled $3.9 billion worth of bona fide trades. So all of those traders who were betting on the long upside price of nickel suddenly had their profits completely wiped out. For arbitrageurs who were long nickel against a short ETF position, for example, who thought they were perfectly hedged, had one of their legs completely wiped out and suddenly found themselves only short against this high skyrocketing price of nickel. And these externalities created by exchanges that are continuing to run these old-fashioned versions of risk they're not just localized to London, they affect global markets. And we have to ask ourselves, who bears the cost? Who is bearing the cost of these models that are putting the risk and the requirement to cover these losses on all the participants? FTX now has an opportunity with our application with the CFTC, with our bringing of FTX US derivatives to US customers, hopefully this year, to follow in the long tradition of technology, which is to say that no status quo is unable to be disrupted. It's our job as technologists, it's our moral duty as technologists to always be challenging what's happening, to say, if we were going to build this from first principles again, how can we do a better job? How can we create a fairer market? How can we create a more open access market that enables participants to safely interact with the products that we require to be able to run a functioning and healthy US and global market? We're looking forward to working with the CFTC on completing this application and bringing these products to the US customers. And thank you all here for being part of the crypto ecosystem, which is challenging the status quo in a million different ways. Thank you all very much.